Hey everyone, and welcome to the halftime update 2023. We're going to do a little bit of looking at the stock market, bond market, commodities markets, alternative assets, intermarket relationships, market breadth, other indicators. So I'm going to look at a bunch of different things as usual. Try to be a little bit more organized this time, and might even kind of keep the format relatively similar every quarter. Make it easy for me, and maybe even make it easier for you all to know what to expect each and every time. So, first of all, apologize for my voice. Got back from vacation about a week ago and caught something either on the plane or in the airport, and I'm on the downside, but getting better. But my voice is going to be a mess this whole time, so bear with me. All right. Another thing. This is being recorded after the market close on Tuesday, July 11th. All the charts that I've posted have been published. You'll see the published dates on the charts, but they're all based on last Friday or yesterday. So it might be Friday's close, it could be Monday or Monday's close. So just keep that in mind as well. For those of you that are looking at what the market did today, we're not getting that. We're not getting that detailed. We're not looking at daily or hourly charts here. That's the second thing. Third, if you'd like to get a hold of me, my office, if you'd like a second opinion on your portfolio, if you'd like to discuss going through our financial planning process, to get a comprehensive retirement plan, investment management plan, estate plan, tax plan, insurance plan, my promise kit, all the things we do here, all you need to do is go to our website at libertaswealth.com. Click on the little button that pops up at the bottom, and you'll have some questions you can go through. And then we'll get a notification, and we can reach out to you to get an intro call, a phone call set up on the calendar, to have a conversation with me and just kind of learn a little bit more about you, understand our process, answer any questions you have. You can also email us at info@libertaswealth.com, and you can also go to our website at libertaswealth.com to the contact page. And there's a form, like a form message there where you can type in a message if you'd rather go that way. So bottom line, lots of ways to get a hold of us. So social media, you can find us on social media as well. The only difference is the bottom left there. I forgot to change the Instagram handle for me now is Adam D Koos. It's no longer financial surgeon. And Instagram is one of those things. It seems like everybody knows their Instagram handle, but people don't know who you are. So I decided to change it to my name. All right. Hopefully I'll make it through this thing. So our agenda today. Our agenda is to go over macro analysis first. Asset class momentum rankings. So big picture, top down. Second, we're going to go over price and trend of the stock market, bond markets, commodities markets. Then we'll do a little bit of intermarket analysis, market breadth, sentiment analysis. We'll go over some individual stocks, individual issues, alternative assets. And then we'll finish up talking a little bit about seasonality and some other indicators that I kind of gather throughout my typical work day or work week as I'm doing my own analysis throughout the week. So I'll share some of those with you. So let's just dive right into it here. So quote of the day, I always have a quote. Walter Deemer, market analyst, Wall Street legend, technical analyst. He says the four most expensive words in the financial markets are "this time it's different." And reason I share that one today is because it's so true. I think so many times when the markets have gone through the period of time that we've seen this past 2 years, where the markets just have not been good. Really, you could look at most stocks peaking in February of 2021. And as they've fallen over the following 2 years, and the market has started to get better pretty much since late 2022 into 2023. And as we looked at to February is when I saw the market turn, in my opinion, into an uptrend. And when I say the market, I mean your S&P 500, the NASDAQ, and so on. And you're gonna have to excuse my coughs all day too. I apologize. I'm not gonna do much editing here. But anyway, so the bottom line is that when the market starts going up, and if you have money that's not invested, if you have cash on the sidelines, and you're waiting for things to get better, what you're saying is you're waiting for prices to get higher before you buy. And in no other type of buying, whether it's going to the grocery store or shopping for Christmas or Hanukkah, do you go waiting for prices to get higher before you buy? You either A, buy it because it's time to buy it with no regard to price, or B, You wait, for a pullback and then you buy. And I think that we've had way more than a pullback. I think we'd all agree. We've gone through a bear market this past 2 years. There have been plenty of opportunities to buy, now being one of them. And I don't think that anybody's going to hurt themselves by scaling into the market here or over the course of the next few months, as I think that things are going to continue to get better from here. But that all being said, I'm not a trend predictor. I'm a trend follower. Nobody can predict the markets. So as we go through all this information, understanding that it's all a weight of the evidence approach, what I'm doing is I'm looking at the market right now with short-term to intermediate-term look-back periods. And what I'm trying to determine is where are we right now? Is the market in an uptrend, a downtrend, or is it neutral? In other words, trendless. And what we want to be doing is we want to be buying and investing on the way up the hill. We're not trying to buy the bottom. We want to invest on the way up the hill. And then we want to sell higher. And that doesn't mean sell and go put money in cash. That means, sell an investments that's weakening and then buy something else that's strengthening. It's like if you picture a 4x400 meter race where one runner passes the baton off to the runner that's gone around the track and is slowing down. We pass the baton to the new fresh runner with fresh legs. And then we do it again and again and again. And then sometimes every once in a while that runner's going to break its ankle, strain a hamstring. And when that happens, we don't want to just wait and let that runner sit there. We want to take him off the track and replace it with another runner. And we want to continually do this in our portfolios, essentially staying invested in the playoff teams and avoiding all the laggards. So I'm talking too much already, and I got to get through this in 40 minutes. So let's see if I can do that. Start with macro analysis, asset class rankings. All right. So right now, when we look at it, the last year or so, this is more of a longer-term look at the markets. S&P 500 sits at the top. The All-Country World Index, ex-US, so that's All-Country World Index is at number 2 ranking, so number 2 spot. Money market would be number 3. It's BIL, short-term treasuries. Small cap stocks would be number 4. In order to see this market get healthier and get really a whole lot better, we're going to need to see small caps start to participate more, which we've seen some of that, as you can just see by the recent uptrend here in this just relative performance graph. But we're going to need to see more out of small caps. And if that happens, I think things will continue to get better. Commodities are coming in here at number 5. And while a lot of that's just been in the energy markets in the short term, they've really kind of struggled in the longer, call it intermediate term and longer term, since this past summers. And then if you look here in the basement, last ranked asset class from a 30,000 foot view would be long-term bonds, treasury bonds, so 20-year treasuries. So bonds not looking so good when you look back, but they are, in my opinion, starting to look better. And I think there's an opportunity here perhaps for a really good risk-reward trade where if you put your line in the sand below a very, very narrow, call it shallow, potential level of support, and that level of support is, say, 1%, or not even 1%, 2%, let's just say at most, below your feet, but the upside potential is higher, then that's where you get a good risk-reward trade. So I think there's some opportunities there in the bond market. We'll talk a little bit about that later. From NASDAQ, Dorsey, Wright & Associates, this is their dynamic asset level indicator or dynamic asset level ranking system. Right now, we just saw fixed income, in other words, bonds, move to the basement. All these rankings are done using what are called point and figure charts. What's unique about that is it removes the concept of time. In other words, all we're looking at here is price movement. So if price does not move for an entire year, then you would see no change in these rankings. So that's what's really cool about point and figure charts. So it's similar to what we just looked at, but a different way of looking at ranking systems. So again, we have here, contrary to the prior chart, the relative performance graph where S&P was in number 1, international were number 2. Here we have international stocks at number 1, domestic stocks at number 2, commodities at number 3, money market cash at number 4, foreign currencies, so ex-US dollar, at number 5, and then bonds in the basement. So they both agree bonds are in the basement. They both agree that stocks are the place to be, whether that be domestic or internationally speaking. I'm looking at the NASDAQ specifically here. And then that's interesting. Clear my throat. Now I can talk for a few minutes. So the NASDAQ, percentage of stocks within the NASDAQ. Obviously thousands of stocks inside the NASDAQ. As of Monday, technically Friday close, 30.86% of stocks within the NASDAQ were in an uptrend as defined by a 45-degree point and figure chart. So without getting too nerdy, essentially this is telling us that we're kind of in the low end of the football field here. This is called the 30-yard line. And there's lots of room to go up from here if things were to continue to get better. Obviously, things can always get worse. And as the market started to improve, one of the concerns has been that there's only, call it 31% of stocks in the NASDAQ on an uptrend, when you might expect to see more stocks going up. But the reason why this number is so small relative to what the market's been doing is because a handful of the biggest stocks, the big cap-weighted stocks, are kind of pulling the market up, making the indices, the major market indices, look better than they are. But that doesn't tell me that we should be doom and gloomy or negative. What that tells me is that there's a lot of opportunity for improvement here as we start seeing some of the smaller companies that don't get as much recognition starting to participate in the market if the large cap stocks start pulling up the small caps with them. Back in 2021, we saw the small caps going down and then the mid caps going down, and then eventually those small and mid caps pulled large caps down, which ultimately turned into a bear market that we've been living in. This time, while small caps and large mid caps have still been struggling, at least on a relative basis, it's entirely possible, and in my opinion, I think it's more probable we see large caps pull up the small caps and mid caps as opposed to those small and mid caps pulling large caps down. Obviously, I don't get married to my opinions. I don't invest our clients' money according to my opinion. I invest our clients' money according to what the market's telling me and whether or not it's in an uptrend, downtrend, trendless. And then, of course, we break it down by individual sectors, then individual stocks, and so on and so forth. So it's a lot more complicated than just saying whether the market's going up or the market's going down, or if it's the Dow, the NASDAQ, the S&P, and so on and so forth. Similar chart here. This is the percentage of NASDAQ stocks on a buy signal. A point and figure buy signal just simply means when you have a higher high in price above, in this case, a 2-point per box reversal system. So it's a three box reversal system, but the scale at the right here you can see is $2 per box. So right now, 36, almost 37% of stocks are on a buy signal. In other words, the bullish percent for the NASDAQ is at 36, 37 and rising, which is good. That means that it's at a low point in the football field. We've got a lot of yardage, potential yardage we could go forward. You can see this chart is exhibiting higher highs and higher lows. And if things continue to get better, obviously there's lots of room to go before we would start to get overbought on a bullish percent standpoint. This is my pre-flight checklist. This is something that I look at really often when I'm looking at the health of the market right now, and I want to look back over several time periods. So you can see, short term, there's only one red spot here, so everything else is good or positive. When we look at intermediate term, all blue. Long term, all blue. You can see here, this is the S&P 500, clearly in an uptrend since February, March. This is the same thing here, the S&P 500. Here are a bunch of indicators that put together what we call a market climate, or call it market health checklist. There are some negative ones here in the middle, but to understand, when you look at something like this, again, it's weighted the evidence. If you wait for everything to be perfect, you're never going to invest your money, ever. You're just going to sit and watch things go up as your life goes by. So you got to look at the weight of the evidence, and when the weight leans positive, you want to be investing your money, and you want to be investing your money in the strongest asset classes, the strongest sectors, strongest industry groups, and so on, strongest stocks. So right now, we've got a really positive market climate for the most part. And when we look at this is safe for new entries. So is it safe to put new money to work? And again, generally positive here, at least 2/3 positive. So everything here looks good for the most part. And this is, again, just reiterates why I think that things are looking good now and likely will continue to improve, albeit we are moving into the seasonally weak months of the year. We'll talk a little bit about that later, but that's the only thing I guess I would throw in there as a caveat, is that we are probably due for a pause or a pullback. That would be completely normal, even though the market, as you can see here, has gone through a slight pullback here, a very small pullback of less than 3%. Let's look at price trends of stocks, bonds, and commodities. So let's look at, first and foremost, the S&P 500. Here's the S&P. This is the October lows, where we've been saying what we felt is I'll just say it was a very high probability, I think. And that probability continues to get higher, by the way, as time goes on, and we see higher highs and higher lows in the market, that October was the bottom. Now, is it possible things roll over, things get worse, and we see a lower low than October? Of course, it's entirely possible. Is it probable? A whole lot less probable every time things get better and better. So again, we have a low here in October, a higher low, higher high, higher low, higher high, higher low, higher high, higher low. That's what we want to see, is higher highs and higher lows. As time goes on, the probability also increases to see a pullback or a sideways congestion, call it digestion over the course of time. So markets, when they correct through price. In other words, this market could come back down to this low here, or the market could even come back to this low here. So it corrects through price or time. And what I mean by time is sometimes the market will just chop sideways, and it'll just kind of digest the gains over time as opposed to digesting price. When I look at my inverse traffic light, which I've updated for this presentation, we have gotten through these higher highs and higher lows, through the caution zone, into what I would consider the green zone, which marked the summer highs of 2022. We saw the market break out, retest that level, break out again, higher highs in the short term. The question is, are we going to hang in here and stay above those summer highs, or is it going to break back down into the caution zone? If it does, that doesn't mean we need to go running for the fences. It just means, I think, because currently the trend is up until proven otherwise, and because the trend is up until proven otherwise, it is my opinion that any kind of pullback would be another gift or a wonderful opportunity to be buying when things are on sale, not to be looking at it like, oh man, maybe I need to validate my opinion that I think the market's going to crash, and because the market's going down, see, I told you, I'm just going to sit on my hands. That's not the right way to look at this. You have to be objective. You can't look at this in an emotional way. So as the market were to pull back into the yellow zone, all I'm looking at this thing going, okay, we're in the yellow zone, we're in the caution zone again, but the weight of the evidence is still positive. We still are seeing higher highs and higher lows in the intermediate term, and until that changes, the market is in an uptrend, and that's just how it is. This is the value line geometric index. This is basically a good representation of the average stock. So earlier when I was talking about how the S&P 500 is a cap-weighted index and the NASDAQ is a cap-weighted index. So when Apple has a good day, the S&P has a good day. When Microsoft has a good day, the S&P has a good day. When NVIDIA and AMD have a good day, the NASDAQ has a good day. So you don't see the little guys underneath, all the little stocks, but you do in the value line geometric index. And what's interesting about this is a monthly chart going all the way back to the late 90s. You see these big momentous highs here in 1998, and then the huge drop, obviously, through the dot-com bubble. Then you saw it hit that level again, and then we had the Great Recession and the real estate crisis. Then we saw it hit that level again in 2015 into 2016, and it pulled back. Then it broke out into 2018, but COVID happened, and then 2018 we saw 1 month where it was below that line, and then COVID happened. Obviously, everything broke down, and it broke back out. So in other words, it reverted back to being above that line in the sand. And then just this past year in October, it tested that what was a previous line of potential resistance, overhead resistance, now becomes support below our feet potentially. And so far, the market is respecting that floor of support and holding above that level. So that's an important line in the sand to add to our, call it, our quiver of arrows and things that we have in our arsenal in terms of analysis. And so this is one of the things I'm watching. This is the All Country World Index ex-US. So this is all international stocks. And what you'll notice is we're seeing a lot of the same thing, just a little bit more momentum off the bottom. So if I go back to the S&P chart real quick, you can see here kind of a steady series of higher highs and higher lows. if I look at the international chart, it's a real big bounce off that low, almost a V bottom. Some might call this a head and shoulders bottom, but I don't know. It's pretty messy. But anyway, so you got a low here, higher high, higher low, higher high, higher low. So international stocks are also doing well. When we look at commodities, commodities did really, really well out of COVID. And the reason why they did well, if we care about a reason that is, which I really don't, but it's because of inflation, as we had this supply and demand imbalance with the inability for companies to make stuff that people needed to buy. We ended up with this huge imbalance of available product, and thus we ended up with a whole lot higher prices. And so as the supply and demand balance grew bigger and became a bigger problem, prices got higher for everything from metals to non-ferrous metals to lumber, things that we need to make houses. I don't know, during COVID, nobody's going on vacation. They're doing home improvements, so, people aren't buying new cars, they're buying used cars, but then there was no used cars. Still isn't any used cars. But since summer of 2022, so last summer, while we've seen a recent bump in commodities, again, largely due to energy, commodities have been kind of a consistent intermediate downtrend since then. So with the exception of gold, which I'm still a fan of for the time being, and when I say fan, by the way, I don't like gold. It's just I like anything if it's going up. But gold is an investment that I would still consider within the commodity environment, which I'll show you that in a second here. This is the U.S. dollar first. U.S. dollar was just killing it all the way out of COVID up through 2022. Here in September, we had all these billboards, Bloomberg magazine, I think it was, The Economist. They were posting magazine covers, things like "Can't stop, won't stop." The U.S. dollar is going to go up forever. And right when that happened, the dollar kind of pulled back, went into a correction. Now, since then, we kind of have this choppiness, this pressure cooker that's building up in the U.S. dollar. This is the ETF for the dollar, by the way, UUP. And at some point, this is going to break out or it's going to break down. My feeling is it'll probably break down. That's just my guess. I don't know if I'm going to be right or not. Obviously, I'm going to act upon what the market does, not what I think it's going to do. So if it breaks down, then that means that international stocks are probably going to become even more favorable, because when the U.S. dollar falls, that makes international stocks more attractive as price rises overseas for currency risk. But if the dollar were to break out and the dollar goes higher, that's going to make U.S. stocks more attractive relative to international stocks. So we would want to kind of increase, or I should say decrease, the amount we've gotten in international currently, and then increase our allocation to domestic stocks. So right now, watching the dollar, actually really important, more important than usual, to kind of see which way this is going to go, because it's going to tell us a lot about whether or not this, call it 13, 14-year bull market in relative performance of U.S. versus international, if that pendulum is changing into the direction of international instead. So for more than a decade, U.S. has been outperforming international. It would make a lot of sense to see international stocks start to outperform the U.S. But we'll see. This is the Treasury yield, so it's 10-year Treasury note. This is what here in the U.S. we use to track mortgage rates, is the 10-year note. You can see here we got three tops. Does that mean it's going to stop? No. Is this line a hard ceiling that rates cannot go above? No. The rates could continue higher from here, although I do think that the Fed is probably close to being done raising rates. They might have one or two hikes left, albeit small. But as this gets closer to slowing down, as it's already slowed down, obviously, I think it's going to help bonds. This back here is when bonds went limit up on rates going down during COVID. Ever since then, we've seen higher rates as a result of, obviously, the Fed trying to combat inflation. If we flip this upside down, it's interesting. This is bonds. So I'm going to go back one more time. 10-year rate, they're inversely proportionate. Rates go up, bonds go down. Rates go down, bonds go up. That's how it works. This is why we haven't owned any bonds for, not even more than 18 months at this point. So working on 2 years, we haven't owned any bonds, and we're just now, today actually, I'm starting to dip my toes into some high risk reward opportunities in the bond market. But this is It's the 7 to 10 year Treasury bond ETF. Here's where it went limit up in COVID, tanked, came back, kind of, and then rates started going up, bond starts going down. It was no bueno. So here we are with this kind of triple bottom that we're looking at going, okay, is it time for bonds to start kind of mean reverting at this point? Are we going to see a healthier market for bonds in the future? We don't know, but we'll see. This is the 20-year Treasury bond. This one looks even more symmetrical if you look at the bottom here. Again, 3 bottoms, obviously lower highs, but almost equal lows. So the question here again is, are we going to see higher prices from here as opposed to lower prices? If things went lower, the only line in the sand right here, and the intermediate term would be, about $90, $92 per share for TLT. But if it went up, I think our ceiling would be back at this 108 level. And then from there, if it were to break out above 108, then we'd be looking at 120-ish for a next target. But right now, again, like I mentioned earlier, kind of a good risk-reward opportunity. And we've taken that opportunity today, and we'll just kind of see how things go. If it go up, we hold on. If it goes down, we cut bait. And that's that. This is a little bit closer look at TLT, the one we just looked at. If you go back in time, this is a candlestick chart. Market goes down, crosses below this line, but then there's a pullback. And this is, by the way, not a pullback in the market where most times when people say pullback, they think the market pulling back, going down. I'm using pullback in technical terms and technical analysis. When you have a pullback, that means the investment in question. Oops, sorry about that. That means the investment in question was pulled back up from the bottom. There's also something called a throwback, and that would be in the opposite. If the market or the investment were to pop above this line and get thrown back down, that's called a throwback. But anyway, we have a pullback here. And now we've got this drop below the line again. And the question I have right now, and we'll see, is are we going to get another pullback back into this range and potentially see higher prices? If we do, again, we're holding on. Otherwise, we've got a nice entry here. Good risk-reward trade below these lows, at which point we would cut bait. Looking at a relative rotation graph, this is upper left-hand corner is improving versus the market. The market would be the very middle, the 0 point on the XY axis. Leading the market, upper right-hand quadrant, weakening versus the market is the lower right-hand quadrant. And then the lower left-hand quadrant would be lagging or underperforming the market. You can see over time here, this is a time ticker at the top. As time has gone on, what we're seeing is consumer discretionary, in other words, luxury goods, getting better. That's what we want to see in a market that's improving, is we want to see discretionaries doing better, and we want to see staples doing worse. If staples are doing worse, that staples are a defensive sector, so we want to see luxury goods outperforming staples, and that's what we're seeing right now. So again, more evidence that things are getting better. When I look at the bond market, it's kind of messy, but this is all the bond positions in my inventory that I follow. And as you see this go by, we see short bonds, we see corporate convertible bonds, and short bonds being in the lead, while long-term, intermediate-term bonds have still been kind of in the lagging quadrant down here, trying to make their way northward. So here's zeros, TLT, VCLT, all these are kind of trying to make their way back northeast, which again adds to my idea that perhaps this is a good risk-reward opportunity to buy into TLT here and some of these investments that have been lagging for so long, assuming there's, of course, an exit in place. Let's change gears, talk about market breadth, sentiment analysis. We'll talk a little bit about that too. First thing I want to show you, and the upper pane is going to be the S&P on every one of these charts. Or I should say for the first five charts I've got for you here. So the upper pane is the S&P, the bottom pane is going to be our breadth indicator. So right here in the bottom is the percentage of stocks within the S&P that are above their 50-day moving average, or in other words, their 50-day trend line. And what you're seeing here is as the market's gone up, again, higher highs, higher lows, we're also seeing higher highs and higher lows in the percentage of stocks above their 50-day trend line. That's good. Essentially, that means that market breadth is confirming the higher highs in price. Then this is a little bit slower metric. This is the percentage of stocks above the 200-day moving average, so it's a much, much longer time frame. And you can see here 62% of stocks, and my line in the sand for bullishness is for it to be above 62 In order for it to get bearish again, I would want to see it cross below 40. But anyway, so 62, it's gone above 60. We're at 62% right now. That's good. And again, higher highs, higher lows, and the percentage of stocks above their 200-day moving average. The only thing I'll throw in here is back in February, we had a peak, and it has not seen that peak again since then. So this is, again, where some of the market participation, so call it the little soldiers, all the soldiers in the market aren't necessarily all following the generals, the big, huge, large cap stocks. So we want to see this continue to improve, and in a perfect world, we want to see it exceed this level back here, which I think I can't tell right now, but it was probably around 72%, something like that. Bottom again here, what we're looking at, top of the chart against the S&P. This is the percentage of new 6-month lows in the S&P. So when you look at the 500 plus stocks in the S&P 500, this is the percentage of stocks within the S&P 500 exhibiting new 6-month lows. And as you can see, we got flatline, nothing. So very few, 2%. That's good. That's like it's like anti-evidence, right? We want to see more 6-month highs, and we want to see no or very little 6-month lows. So that's also bullish. Here's another one. This is the percentage of stocks within the S&P 500 that are within 20% of a 52-week high. So within 20% of a 1-year high. And you can see again, higher highs, higher lows, and not only higher highs and higher lows, but we've exceeded the highs from February right now. All right. Next one, our last breadth chart here. This is the percentage of stocks within the S&P 500 exhibiting new 52-week lows. I think it should probably go without saying that if we weren't seeing any 6-month lows, we definitely wouldn't be seeing much in terms of 52-week lows, right? And that's exactly right. So 1% of stocks hitting 52-week lows in a rising market, that's exactly what we want to see. So good evidence here. This was interesting at a high mount. I found this chart. This is the median. So the median S&P 500 stock is only up 4% this year. In fact, in June, it was down. In April, it was down 4%. But the index itself is up 16% as of the beginning of July. And that's because, again, there's this handful of stocks that are pulling that index up. That are doing really, really well, and they're all large cap stocks. So we own some of these stocks at our office. We don't own all of them. I wish we did. If I had some way of predicting that, that's all I would do, obviously. But this would be easy, right? And I wouldn't even have a job if that were the case. But our goal is to always keep track of the S&P 500, making sure that we're tracking as much as possible, understanding that there's plenty of stocks in the S&P 500 that aren't doing well. And we're not going to talk about any of those because I don't see the point or the purpose. In fact, I had 4 stock charts I was going to show you that were terrible stocks, but I deleted them before doing this presentation because I thought, what's the point in showing bad stocks? But anyway, I digress. So this is interesting here. Moving on to individual stocks. So there's my segue. Alternative assets. First is Netflix, and I'll disclose we do own Netflix in our portfolios. Netflix looks great. Higher highs, higher lows. Trading above its 200-day moving average. I tend to use the 10-week moving average, which is the same thing as the 40-week moving average, as opposed to the 200-day, but they're the same thing, mathematically speaking. But Netflix looks really good. Another one, again, we also own this. NVIDIA also looks really, really good. Got a nice little gap up here back in about a month ago. And then we have the stock continuing to just follow through to the upside. Sometimes what happens when you see a gap like this is the gap has a tendency to get filled. In other words, on the right side of the chart, we'll see the stock go back and kind of digest and kind of close this gap up by going down, and then it'll head back higher. But at least so far, this is looking more like a runaway gap, which is good. So we've got a rising 200-day moving average and 40-week moving average as well, not shown on this chart. NVIDIA looks great. One of NVIDIA's competitors, AMD, also a stock we own, doing really well. Higher highs, higher lows, rising 200-day moving average, 40-week moving average. Everything looks good here. Pulled back with the market. Obviously, one of the tech stocks, big cap stocks that have been pulling the indices up. Cadence Design Systems, another stock we own. Also, again, same story here. I mean, you can obviously catch a theme. We have higher highs, higher lows. Let's see if I can figure out how to draw a line here. I can't find my Well, I can't find my tools. Anyway, they're hidden on my screen for some reason. But from right to left, if I draw a line here, see this high? If I were to draw a line, you can see how this low here almost corresponds with this high here. So the market goes up, breaks out to new highs. Not the market, but CDNS does, Cadence. And it pulls back, retests this high, and then heads higher. So another stock that looks like it's doing really well. Gold, I mentioned earlier, I do like gold right now. We still own gold. We're still positive right now, but gold has been going through a correction in price to the tune of about 5% or so right now. I like gold still as long as it stays above this rising 200-day or 40-week moving average. If it closes back below, the 1850, 1860 level right now, I'm not really interested in owning it anymore. A lot of headwind for gold with, if interest rates stop going up, then that's a good thing for gold. But inflation, if it stops going up, that's not good for gold because obviously gold is an inflation hedge. So if inflation starts to slow down, which I do expect it to do, I do expect inflation to start slowing down in the very near future. It's actually already been slowing down, but I expect that to continue. Then that could be an issue. And then if the U.S. dollar starts to go down in value, then obviously that would affect gold as well. So we're just going to have to see what happens here right now. But we've got this huge smiley face. If you drew a line underneath this is called a cup. This is a handle, a cup and handle pattern. And then if this breaks out above this descending trend line, then that would be a good opportunity for new buyers to get in. And then obviously a breakout above these highs would put gold into all-time highs with nothing but sky to contend with. So we'll have to see what happens if gold gets worse. We sell it. If it consolidates sideways and then heads higher, then we hold on to it and participate in the gains. Silver, I only brought it up because I thought somebody might ask. But silver, on a relative basis, it sometimes outperforms gold in the short term. But again, same story here. This is silver's futures. We've got a rising 200-day moving average, and we've got the price of silver just riding that moving average, riding that trend line. So if it's above that level, then I'm okay owning it. If you want to be super aggressive, then I put my line in the sand right here around $20 a share. I wouldn't want to own it below that. But that's silver for you. For the crypto people out there, the digital assets, Bitcoin, higher highs, higher lows, bottomed out here around $15,000, $16,000 per share, per token technically, and now we're sitting up around 30. So we're gonna have to see what happens. I don't know if people are getting bored with digital assets. If they're bored with Bitcoin, they don't care anymore. You don't hear as much about it on the news. Obviously, it's a whole lot less exciting to buy something at $30,000 than it is to buy it at $3, right? But Ethereum, similar story, looks very similar in terms of trend. It's riding a rising 200-day moving average, sitting at 1863 for Ethereum, with the 200-day moving average sitting at 1704. So far anyway, Bitcoin and Ethereum are both kind of respecting this 200-day moving average, which, if I haven't said it before on these presentations, digital assets have nothing. There's nothing behind them. There's no backing. It's an investment that is traded and it goes up and down purely on behavioral psychology and supply and demand, which is why it makes technical analysis and trend following such a wonderful way to manage digital assets, is because it is so purely behavioral, and technical analysis is basically the study of behavioral statistics in the markets. So because it's respecting this 200-day moving average, if it's above there, I don't see any problem with owning it. But if it starts to close below there for longer than, say, 2, 3, 4, 5 days, or if you use a 40-week moving average and the end of the week for a high volume close below, then I'd be cutting bait. But I do not own either. This is natural gas. Natural gas was doing wonderful right up until last summer, at which point it peaked and dropped about 82%. Just got hammered. Now recently there's been some talk in the news about, natural gas, it's up, 20% in the last couple months. It's like, well, yeah, but you can see how how bad it still sits down here. Now, this is speculation. If you're buying down here, and or if you're a shorter term trader than I am, my time frame is intermediate. My time frame is not short term. I'm not a swing trader. I'm not a day trader. So I would not be interested in UNG or natural gas until I saw this thing prove itself a little bit and start to build the right side of its base. Start to build more of a smiley face here. Hit maybe this level right here over at about $9 a share, pull back again, and then that might get interesting. But until then, this is just a very speculative, high risk. I don't want to say low reward because you just never know, right? But high risk trade that I'm not really all that interested in. A couple sectors that are really strong right now. Technology, obviously. The tech sector, especially semiconductors, have just been absolutely killing it. So we do own this ETF in our portfolios or in some of our portfolio models. Just full disclosure, but technology is doing well, and so are internet stocks. This goes back to Meta, Facebook, and other internet stocks are doing really, really well right now. So higher highs, higher lows, rising 200-day moving average. That's what we want to see, and we want to be staying invested in the playoff teams. We avoid the rest, avoid the laggards, and that's what we're doing right now. Switching gears to seasonality before we close up. Lowry Research does their buying power and selling pressure index. Right now, it's been a mess really this past year plus, where there really is no direction that's been able to sustain itself in terms of buying power or selling pressure. Right now, buying power is in the dominant position. Both are kind of chopping sideways. Here's selling pressure, chopping sideways. It would be more encouraging to see buying power exceed the first quarter highs, and then to see it exceed the February highs as well. That would get me excited and make me feel even more confident about this market. But right now, we're at a seasonally rough time for the market, which means that it's really kind of a time to expect some stalling and some pullbacks and some digestion over time. This is a put call option. This is from CNN, part of their fear and greed index. One of the indicators in there is a put call ratio. This is really low. And what I mean by that is that very, very few people, when this is low, very few people are buying puts and insuring against the market going down. In other words, right now, people aren't concerned. When this number's high, they're worried because they're buying insurance. In other words, they're buying puts in the market. Right now, that's not happening. Fear and greed index right now, because the market's been kind of rebounding off the lows. It's done well since February, especially. We're at a point now where we're at a 78 out of 100 level. So what CNN would consider in their indicator be extreme greed. We could expect this to pull back as the market pulls back or as it digests over time. And you can see kind of where it was a month ago at 77. So all in the 70s between yesterday and a month ago, but a year ago, super fearful. This is from Sentiment Trader. Really interesting chart here. It's been more than 70 days since the last 5% pullback in the market. And that's pretty rare. I mean, the market goes up and goes down, right? It breathes. The general trajectory in a bull market is for the market to go up, but you get pullbacks, you get corrections. It happens. That's just part of the regular everyday movement of the market. But it's been over 70 days since the last 5% pullback. And when we look at the statistics, after 68 days without a 3% pullback, and recent multi-year high. In other words, we're not at an all-time high, but 52-week high. You can see what the statistics are. So when this happens, which it's already happened, a week later, the market's down on average 0.2%. 2 weeks later, it's down 0.6%. A month later, it's down 0.2%. So essentially, the market kind of goes nowhere for a month on average. But then 2 months later, it's up 1%, 1.2, 3 months later, up 3%, 6 months later, up 7.5% on average, 12 months later with a 73% win rate. In other words, sometimes it's down. The max loss is 5.6% going back to the 30s. But these numbers are encouraging. It's just telling us that even if we are at a little bit long in the tooth, and even if we haven't seen a pullback recently, it is probable that we will see a pullback. But that doesn't mean that we should go running for the fences. Here's another statistic. This is after 70 days without a 5% pullback and recent 52-week, but not multi-year high. I know it's a mouthful, but this is what's happened right now is 70 days have gone by without a 5% pullback. We've been at 52-week highs. but not multi-year or all-time highs. And again, you can see 1 week later, the average return after these instances is 1.1, pointing down 0.3%. 2 weeks later, up 0.5%. A month later, nowhere. 2 months later on average, which is interesting, that's exactly 0. But 3 months later, up almost 5. 6 months over 5. 12 months later on average, over 9% with a 90% win rate, looking at this sample size here. So again, I would expect, and if there is a pullback in the market, whether that's, again, in time or price, that would be something that shouldn't surprise you, and it's definitely not going to surprise me. Fun, interesting statistic here. This came, I think it was Ryan Dietrich that found this, that I saw on Twitter, but I thought it was really interesting. So Wall Street strategists, on average, you can see they're picking a bearish second half of the year going back to 1999. The most bearish second half, in fact, is what they're predicting. So these are the analysts on Wall Street. And when you look at the last 3 times it was negative, in 1999 they predicted it to be negative, and it was up 7. 2019 they predicted it to be negative, it was up 9.8. 2020 they predicted it to be negative, it was up 21. And then 2021 they predicted it to be negative, and it was up 10.9. So this is the worst projection ever. Not ever, sorry, since the 90s, late 90s. It'll be interesting to see what happens the rest of this year as the year unfolds. Another quick thing here to look at, indicator, this is average years don't happen a lot. So when people talk about the S&P going back to 1950, average rate of return between 8 and 10%, it doesn't happen a lot. You can see here, 8.5% back in the late 50s, 9.1, 9, 9.5. Otherwise, they're bigger or bigger drops, one of the two. So the whole 8 to 10%, that just doesn't happen a whole lot. That's why I always joke about the person who drowned in a river that was an average of 14 feet, or I'm sorry, average of 4 feet deep. Is the average might be 4, but it might be really shallow for a long time on both sides of the river, but really deep in the middle. So what we're looking at here are these big highs, which we want to participate in, and obviously we want to eliminate or at least reduce the exposure we have to the lows at least as much as possible. I've shown this one before in our market outlook presentation. I think I even showed it in our fourth quarter scouting report. What I want to draw your eyes to is here, year 3, pre-election year. Under a new president tends to be the best year. And when we look at the election year under a new president, it also happens to be the best year of the 4-year election, the best of the 3 different choices, average versus re-elected president. So best year of the 4-year election cycle, pre-election year, best of the 3 options. New president, same thing here. New president, year 4, which would be next year. So just good historical evidence that, again, leans toward bullishness. This is the Dow Jones Industrial Average going back I'm going to look at the black line, 1950 to 2015. You can see here, since from 1950 to 2015, just kind of this flat line here in the middle. Even from 1988, a more mature market, kind of flat. It went up here in the summer, but then comes right back down. Same thing when we look at the S&P 500. We look at market, it's July right here. The market tends to go sideways almost until the last quarter, last month of the year. When we have a first-term pre-election year, so first-term president or pre-election year after a midterm bear market, which we did last year, we'd be looking at these 2 lines up here. So again, but same story. The market kind of has a tendency to flatten out over the course of July through November, and then kind of pop at the end of the year. So obviously, we have no idea what's going to happen. We can't predict the future. All we can do is build a weighted the evidence approach and determine whether or not we want to be bullish, bearish, or neutral, or somewhere in between. I always say it's a dimmer switch. It's not an on-off switch, and we want to stay invested in not everything. We don't want to diversify our money to everything. We want to diversify our money in the playoff teams and the strongest investments, while avoiding the laggards and avoiding the worst. So I'm going to go ahead and close today. Actually, I have an appointment that's starting exactly 2 minutes ago, so I really got to end here. But reach out to me if you have any questions about this presentation, about your portfolio. Again, you want a second opinion on your retirement plan portfolio, please reach out to me. Be happy to have an intro call with you just to get to know each other and determine whether or not we even have a reason to take things forward from there. We're super, super low pressure here. I would say I'm the worst salesperson in the world. So my goal is here to educate you, make you learn a little bit more every time you watch one of these screencasts, listen to our podcast, read our articles. This isn't work for me. It's fun. So thank you so much for your time. Hope you got something out of this halftime update, and hope to see you soon.